Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I am here to bring you trading levels in some popular company symbols for the upcoming week of August 5th, 2024. As part of that, I think it actually makes sense to start with a brief market recap because the last couple of days of trading last week were kind of action-packed and are certainly going to impact everything that I'm about to talk about in terms of individual symbols. So I think it makes sense to obviously start with a really quick top-down analysis. In addition, I'm also going to talk a bit about earnings announcements because, again, a number of the symbols that we're going to take a look at all announced earnings recently, and they had some really strong moves, primarily in the negative direction. And so as a result, there are the potentials for bargain hunting, whether it's a matter of putting stuff into one's portfolio, or just in terms of trading, in terms of short-term trades where one is looking for a bounce, or at least for price to bottom out. So for all the above reasons, I think rather than diving in immediately onto the charts of the individual symbols, I think it makes sense to talk about things from the top down. So I'm about to do that. So before I get going here, of course, the usual disclaimer, everything that I'm about to show you here is for information and educational purposes only. Precision Trading Labs, we are neither money managers nor financial advisors, and nothing that I'm about to show you here should be construed as investment advice. There you go. All right, so we're going to take a look at the triple Qs, which of course is the ETF of the Nasdaq. A lot of the symbols that I'm about to show you are Nasdaq symbols, and particularly those that are tied in with tech. So rather than looking at the SPY of the for the S&P, we'll look at the triple Qs. Having said that, of course, any number of major symbols, of course, are in both indexes. But nonetheless, I think in terms of focus, so we're going to take a look at I'm going to look at the Qs here. Plus the fact there is something very noteworthy about the Qs. So I think it makes sense to do that. So here we go. Here's a daily chart of the Qs here, and so this dashed line here, this marks the close of the prior Friday. So right here, 1, 2, 3, 4, 5. Those are the 5 trading days of the week that just concluded. And so you can see price. And in fact, let me just blow this up just a bit here. So price obviously popped from here. Okay, drop down here. Then we had this this move up here, which was Wednesday, and then Thursday it opened here. It had a brief flirtation with actually moving higher, and then it just kind of slammed down on Thursday. And then yesterday it kind of really kind of emphasized the very bearish move of the prior day with a large gap, and then obviously then a significant move down, and then it actually recovered about halfway by the close. But anyway, that was the narrative of the Qs. But what's particularly noteworthy about the Qs, though, is if we look right here, this was the all-time high here, the 52-week high, and of course the all-time high. And I think that was July 16th, I believe. Where is that here? No, yeah, I'm sorry, July 10th. And so that was your all-time high here on the Qs. And if you notice, from this all-time high to where we are now, what I've done is I've run this line here, and I've set up a percent change label. You'll notice that it went from here to here. That's almost an 11% move. And so for those of you who are aware, and of course for those who aren't, if anytime you have a move down from a local high of at least 10%, that's considered to be an official correction. And as a result, if you were watching CNBC yesterday, or Bloomberg, or if you read the weekend edition of the Wall Street Journal, you're going to see the term official correction over and over and over again. This is meaningful, mostly from a matter of psychology. So as a result, the fact that we actually are down just a little north of about 11% from the all-time high, that says something, and it impacts on sentiment and impacts on emotion. So I thought it was worth pointing out here. All right. So if we now pan out on the chart here, so here's where we are now. And what I do want to focus on the Qs is this region right here. Notice right here, price basically came up here, and then notice the next day it consolidated within the range of this this candle here. And of course, you can see the open and the close are relatively close together. And then right here, you had this very, very bullish move out of there. And then a significant outside gap, and then another very, very bullish move. And this thing actually closes virtually at its high. There's just a little hint of a wick there. So this pretty much closed at the day's high after that significant gap up there. So that kind of went from what, 445 all the way to almost 454. So that was about a 1.5% move up there. So that was actually a significant move there. So right in here, this is what I want to focus on, is that within this region right here, there was essentially a range of narrow trading for the better part of, let's say, 1 to 2 days. And if we think about the shares that are acquired by buyers, we can think of that as the demand for shares, okay? And so those are the shares that are acquired by buyers. If we then consider the shares that are offered up by sellers, we can think of that as the supply of shares, okay? And so within here, okay, where you're trading within this relatively narrow range, we can say that supply and demand are in balance. Okay, they are basically balanced within this relatively narrow range, and then something happens right here. Okay, and what happens right here is an exhaustion of sellers. Nobody is willing to sell here anymore. At the open, people certainly were, or institutions for that matter, but that evaporated extremely quickly, and you could see that over the course of the day, very quickly, nobody wanted to sell here anymore. As a result, we can think of this as an exhaustion of sellers. Nobody's willing to sell here anymore. So right here, okay, if there's an exhaustion of sellers, we can also think of that as an exhaustion of supply. Okay, and so right here, where supply and demand were balanced or in balance, or to use a 50-cent word, at equilibrium, okay, that equilibrium, that balance is broken here by this exhaustion of sellers. Consequently, what's left in its wake, where supply and demand were in balance, once there's an exhaustion of sellers, there is no longer any supply here left, only demand. Consequently, we call this a demand zone when it meets various qualifications in terms of candle structure, how much time duration there is here, and then the quality of the exit, both in terms of the energy of the exit that emerges from the zone, as well as the distance that it travels. Those are all kind of things that we evaluate in terms of a demand zone. Okay, and then the foundation, and the reason we talk about this, is that this is the foundation of our trades. At least for us at Precision Trading Labs. And so what we're waiting for is for price to return to a qualified demand zone. And at that point, when price returns to a qualified demand zone, that is the foundation to place a bullish trade. And I'll talk about that when we get to the next slide here, when we actually start to look at the individual stocks. Okay, but you can see price had pulled back to this region here. Okay, and then it actually got a bounce, and then price was off to the races there over the course of the next 2 or 3 weeks. Now, I'm not suggesting for a moment that one was going to capture this entire move. Okay, but once this price action occurred right here over the course of about 2 weeks here, we were then waiting for a retracement back to this zone, and then this was going to be the foundation of a bullish trade. And so this is what we had shown to our subscribers, and a number of them obviously were rather happy to get into trades based on that zone. Okay, so now we're waiting from that. Now, of course, we had this this correction here. We're back to here, the present. So this correction. So we're about to hit this zone yet again. And under a lot of circumstances, I might be a little wary here. But in fact, price was really here for a relatively short amount of time. It only drove into the zone by about 25%. So I think it's quite likely that there is still residual demand in this zone, which we can think of as untapped upward price pressure. And so when price returns to this zone, we're going to be inclined to now place a bullish trade once we reach this zone. And you can see we're obviously not very far from it. Okay, so right now we're at 448. You can see that this is around 444. So obviously we're down, we just need more or less another pullback of about 1% or so. And then that would be our trigger to get into a trade based on the Qs. But of course, we're also going to be looking at this chart in terms of helping us guide our assessment of various other stocks that are in the QQQ in terms of top-down analysis. So at any rate, I kind of wanted to go through what went on with the Qs and where the levels are for the Qs, because essentially then we're going to kind of keep our eye on this. So we'll keep it in our heads here that this demand zone on the Qs is about 1% down from there. And then the next entirely fresh demand zone is about 4%, about 4.5% down. So those are the two things that we kind of really want to keep in mind. This lightly tested demand zone at 1% below current price, and then this other one about 4.5% down, which is entirely fresh. And then that's down there. Okay, so all right, so that's the story with that. So now we're actually going to go in and take a look at some of the individual symbols here. So first one we're going to take a look at is Amazon, and all this week we had actually put on and done some analysis beforehand. So we had actually done a number of subscribers had put on a number of straddle trades based on the earnings announcement. I'm really not going to get into the great detail about that here, but these are kind of the notes that we had put in. And what we do is we assess the average move that it's made over the last 2 or 3 years, so we can kind of see what its move has been off of earnings the next day. We've looked at the history of what the at the money earnings straddle looks like. We do an assessment of implied volatility, both before and after earnings announcement. So this is all of our analysis that we kind of did in terms of creating the setups for these earnings announcement straddle trades. So in fact, here on Amazon here, here's where we got in on August 1st. There's a little typo there. Let's fix that. So on August 1st, we got into this trade right here. So this is where we got in. Okay, buying the straddle out about a week or so before expiration. So here was the at the money straddle, and so here was our entry price. And then at the next day's gap, we did get a sufficient move down, and so that actually turned out to be a real nice trade with Amazon, and we ended up picking up about $6 off of this $43, off of this $15 entry. And so as a result, getting up to 21, that was about a 39-40% move there off of that straddle. So that was kind of awesome. So this is the kind of stuff that we do in terms of when earnings week is around here. So this is one of those setups, one of those charts now where we're about to talk about, well, potential bargain hunting here. So now that this thing got taken to the woodshed, and it closed down about 16% here. There was a little recovery. That was at the absolute low here at around just a bit above 160. So now that it's here, the question is, what do we do here, or is there anything to do? So right here, where it closed, okay, this is the close right there at 167.90. Call it 168. So the next fresh demand zone is actually just about 9 or 10% down. So in the short term, we don't necessarily see that there is any reason to kind of jump the gun on getting into Amazon, at least based on its own chart. The one thing I will say, though, is we had those other levels on the Qs, okay? And so as a result, I'm also looking at this level right here. Okay, this is really not a qualified demand zone at all. Okay, but you can see price did consolidate, it popped, it dropped, it popped out of there again. So I'm going to keep an eye on it. And the thing is, though, what we're going to look at is if the Qs show signs that there is going to be an energetic move to the upside, well, then this might just go along for the ride. Obviously, Amazon is a key part of the is one of the higher valuation percentage-wise of the Nasdaq, and so even though its chart isn't necessarily a prime foundation for a trade, this might just go along for the ride with the broad market index. So I'm not going to jump the gun on this in terms of recommending anything, but we are going to keep an eye on this. But in terms of in terms of a level where the chart just kind of stands on its own, that's the level right there. That's about 9% down from current price, and then this other one is only about 2/3 of the way down, and that's about 6.6%. So that's kind of the thought about that. All right. So in terms of what we would do here is, if when we get a pullback to either this zone or this zone, this is where we would express a bullish trade. And so in terms of expressing a bullish trade, obviously the most direct way is to buy the stock. One, of course, could buy a call. One could also do a bull call vertical debit spread, and that would be a way of lowering the premium and making it a gentler, more forgiving trade with a lower delta, and also reducing the effect of time decay because of the fact that you're buying one call and you're selling another. And so as a result, theta is largely negated when of course you're selling offset, when you're buying and selling options there. And then, of course, if one wanted to collect premium, one could, of course, execute a bull put vertical credit spread. And then at that point, then one could sell a put at a higher strike, generally just out of the money, and then buy a put further down at a lower strike. Okay. And so that would be a way of another way of expressing a bullish trade out of one of these two zones here. All right. So that's that's kind of the rundown on Amazon. If we turn to Intel, yet another one that got thrashed. They announced all kinds of labor cuts. They're going to be, I believe, putting their dividend on sabbatical. So that was not met with any great enthusiasm. This thing was closed that down about 26%, and in fact was down significantly more. Again, we had a really nice straddle trade on that. And so here was our entry there, and we got the sufficient move down there, and so that was a particularly awesome trade where we got in at 285 and we actually exited at 8 because of the magnitude of that down move, and so that was 180% on our money there. So that was quite awesome. All right, so now that the earnings announcement is passed and the straddle is over, so what, if anything, is there to do with this chart? So if we go back and look at Intel, this is actually now sitting at multi-year lows. Price has not been this low in a long time. And so I'm going to kind of show that to you right here. Before I do that, let me see here. We want to make sure we have enough data in there, which we do. And so we're going to go back in time, and this is where we are now. And in terms of looking for a potential level where we might get a bounce, this was a movie. If this was a movie, the screen would get blurry as we're going into a flashback sequence. So right there's the first level, at least, of something to look at. I'm not racing. Okay, now right here, this is an area of basically multi-tested demand. This was a little demand zone there. Price came up, dropped into it. Okay, responded well to it, came back, dropped in again. Okay, but this is not fresh demand anymore, and of course it's also 11 years old. So I'm really not looking at this as, per se, looking that there are certainly no unfilled orders there waiting to be filled there. But the point is, in terms of market memory, this is where where a lot of buying occurred. One thing to keep in mind, of course, is that if we look right here, we can see just at the bottom of this zone is the $20 round number. That's usually significant. Major round numbers often come into play here. So we will kind of keep an eye on that because the $20 price is sitting right there. All right. And then if we look below that level, there was another one right here. Okay, this is again more or less support, and this goes back further, and that's right here. Okay, and so again, this is a level that I don't think I would really have any great love for at all. There's no round number in it, and this is just kind of sloppy support. So I would not necessarily be racing, at least on its own, to trade. Again, I talked about the Qs before, of keeping an eye on that in terms of a top-down analysis. But really, the first place where there's fresh demand on Intel is really here. Okay, right here, this drop-based rally formation. And so that's already now sitting at 18. Okay, so you'd need about a $3 move down from here, which is about 15 or 16% below where it is now. So, frankly, I'm hoping we're not necessarily going to see that. I'm not looking for the market to get crushed like that. But having said that, if we do get a major pullback where we start to approach a bear market condition, well, then, this is going to go with it. So we'll see what happens here. But anyway, that's the thoughts about Intel. We're going to take a look at Apple. So here's actually we did a straddle with that. This one did not work at all because of the fact that the move on Apple was pretty muted, and so as a result, this thing didn't really move a whole lot. So we got into this at 11:20, and it just didn't work. And it had popped up to here at initially, and in fact, it kind of ran almost into a level of supply here. This probably wasn't the brightest trade I ever put on, and it's just because that level was there. But in fact, it was showing that the average move was 5%. I thought there was a reasonable chance of this, but in fact, it didn't work. So we ended up getting out of that with about a $2 loss. So based on that 11:20, that was about a 20% loss on that Apple straddle. So what do we look at now? All right, so here we are now. So right here, we in fact have this nice drop base rally formation. Okay, and so again, right here is where supply and demand were in balance. Then we have our exhaustion of sellers. Okay, that's where price turned. Okay, so this is where we would be looking potentially to express a bullish trade out of here. So the demand zone is about 5% below current price. And then if we were going to be looking to short, that up there, I believe, is actually its all-time high, and that's sitting at 233. So that's about $14 above where we are now, and that's about a 6% move. So that's the area where we would express a bearish trade. That's the area where we would express a bullish trade. Take a quick look here at Meta. Excuse me. Here was another straddle that we did. So right here, here's where our entry was. In fact, there was the price had gapped way up there, and then actually most of the day it just kind of gave it back. But because of the fact that this thing came right to the doorstep of this supply zone, very quickly we kind of closed this trade out, because even if this thing had gone further, more likely than not, this is where in fact we would expected a pullback because of this exhaustion of buyers that occurred here. Okay, so this is what. So anyway, we got into the straddle here. Okay, we got in at 44.45. That was actually obviously an expensive contract, requiring about $4,500 of buying power per spread. But if one got into that, you got in at that, and then that was the actual price of the stock at the time, 474. Consequently, actually, there's a typo there. We used the 475 strike. So there was our entry right there, and then right there, once this thing kind of got up there, really within about 15 minutes of showing signs that it was backing off, we just closed the trade out here. And so in fact, we got out of this at 51.95, and so we made 750 on the straddle edge. Okay, we got out basically when Meta reached about 525 in terms of its price, and so the value of the straddle had gone to about $52. So that was that. All right, so what do we do now? Well, okay, right there's that supply zone. So in fact, here's where we are now. So in terms of looking for a potential trade with Meta, that's one, basically waiting for a return back to that supply zone. And in fact, looking at the supply zone, one could in fact draw it actually a little more aggressively, which is what this other dash line suggests, by using the full lower wick there. And at that point, if we kind of string that to the side, extend that to the side, then that's the front door of the supply zone there. So that's about 8% above where we are now. Okay, so that's where we would express a bearish trade. And in terms of expressing a bullish trade, we've got this demand zone down here. And so that's about 4% below where we are now. So this is where we would express a bullish trade. This is where we would express a bearish trade. And, I talked about that in the prior couple of slides about the various ways we can express those trades. All right, and lastly, we'll just kind of rip through a couple of more symbols here. Let's take a look at Netflix here. So here's where we are now, and in fact, this is actually a demand zone that's sitting here. But because of the major slam down on the Qs the other day, where a lot of times we might have been inclined to get into this, having the fact that it reached this level, we might have actually got into this. But because of the fact that the market was just so red the other day, we just saw, and plus the fact it was Friday, we just decided to not pull the trigger on anything. So we just kind of left this alone, and we'll see where this is on Monday, and then we'll see what happens here. So in the short term, there is actually no trade here. In terms of the way we would look at this, though, if you look right here, here's our entry at around 615.75. Okay, and the way we kind of gauge how we kind of go through these trades is we determine what our risk is in terms of the placement of our entry, and of course where we're going to get stopped out. And so we would get stopped out, and we would actually take this into consideration because in fact there is a major round number here. So I didn't actually notice that before. So in the short term, I'm just going to say that we would get out, let's say it's 650 cents. But in fact, that may not be the case because of the fact that there is a major round number there. Okay, but hypothetically, if this is what our trade looked like, this would be 1 unit of risk right here. Okay, so if we've got to bounce to there, that would be a 1 + 1R trade, 1 unit of risk. That would be plus 2R. That would be plus 3R. Okay, and then in terms of our position sizing, what we do is we determine what our standard risk per trade is, and then we essentially figure out how many shares or how many contracts, if we're doing options, can we shove into that standard risk per trade based on either share price or the risk reward proposition of an options play. So that's how these trades kind of lay out. So that's the story with Netflix. Again, we're just kind of sit tight and wait to see what happens tomorrow on Monday. If we take a look at Tesla, this is actually a really nice zone right here. So right here, and in fact, there are two nice looking trades here. Right there's a supply zone. Okay, we have our rally. Okay, we basically have a rally-based drop formation here, which kind of really consists of price gapped up here, and then we had another up move there with that actual green candle. So this is what our supply zone is right here, and then here is our demand zone. Okay, so below here, obviously this demand zone is about 3.5% down, and then above here, the supply zone is about 10% higher. But these are two levels that I think actually offer some good prospects for a trade. So again, just to show you what I just went through on Netflix, if we do the same thing here, okay, our entry is at 199.55. Again, a major round number sitting there. 200 is right there, right above this level here. So in fact, it wouldn't surprise me at all to see Tesla test that, and it'll either probably even dip a little bit below it, and then the demand zone should in fact do its job and send price back up. In terms of, again, what does this trade look like? So here's our entry. And in fact, we would also keep an eye on this, because if in fact it goes through the 200 mark, it could just start to turn around. at or around 200. So we don't want to necessarily stand on ceremony and go, well, it's got to get to 199.55. It might just go to 199.80 or 75 and then decide to turn around. Okay, but we kind of know where our levels are, and we also know where the round number is. And so we, you know, if for those of you who are active traders, you know, we can kind of monitor. We keep our eye on this. Okay, and in terms of then the stop out point, let's just see 194.05, and let's just say we put our stop at around 193.50. So that's more or less what our trade would look like. And again, that's 1 unit of risk there, and then that's a plus 1R trade, plus 2R, plus 3R. Okay, so there's our demand zone there, and then above there, of course, is our supply zone where we would express a bearish trade. So at any rate, that's what I got. Thank you for the privilege of your time. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care. Bye-bye.